morning, everyone, and welcome to today's webinar, Early Warnings and Smarter Decisions. So we'll be taking you through the data that you need to know to stay well informed and manage the risks, the multiple risks that are currently confronting Australian businesses. And we'll be presenting that to you through the lens of CreditorWatch's latest data report, the Business Risk Monitor, which is a comprehensive new report launching today, developed by CreditorWatch and our friends at Open Analytics. One way to think of it is Business Risk Index 2.0, if you're familiar with that. So we'll be retaining all of the data that you know and love in the Business Risk Index with a bunch of new metrics as well. So taking you through that will be CreditorWatch Chief Economist Ivan Colhoun. Good morning, Ivan.
Hi, Michael.
And Managing Director of Open Analytics, James O'Donnell. So just a bit of housekeeping. For those of you who aren't familiar with CreditorWatch and what we do, we're one of Australia's leading commercial credit reporting agencies. We are B2B only. We don't manage consumer data. We were founded in 2010. Our CEO, Patrick Coughlin, was one of our founding employees. He's still with the business. And from those humble beginnings, we now have, we're nudging 300 actually in terms of our staff numbers. So fairly strong growth. We have a bunch of unique data that Ivan will take you through today, from our defaults data to arrears data. And we are one of the industry's leading platforms. We have 99% plus average uptime over the last 3 years, which is obviously very important for your business continuity. So just in terms of the data, here's just a slide showing the unique data that we collect. I mentioned payment defaults, arrears data, also mercantile inquiries from debt collectors, credit inquiries on the platform, and then accounting software integration data from the likes of Xero and MYOB. And then we have around 50 common data sources as well, including ASIC, the ATO, the Australian Business Register, and all Australian courts. So we combine all of that data to provide our risk score, our rating system on all Australian registered businesses. And we also use it for the insights that we're going to present to you today. So just quickly, a bit of an explanation of what the Business Risk Monitor is. As I mentioned, it's the next iteration of the Business Risk Index. The Business Risk Index is 4 years old, so we thought it was time for a refresh. It's proven it to be a very useful tool for business owners, credit managers, credit professionals, to give them insight into the state of the Australian economy and also the health of Australian businesses. But yeah, we just wanted to expand it a bit more and provide a little bit more insight. So the Business Risk Monitor includes real world drivers. If you could just go back for me there. So we like to think that we can give people an indication of the direction of business conditions before they hit the headlines. A number of experienced journalists have commented to me that they like the Business Risk Index because it provides data on a monthly basis as opposed to quarterly data that you get from the likes of the ABS. And we also provide forecasts on the Australian economy and business conditions. And of course, we have a strong focus on SMEs, which is data that you don't often find elsewhere. And then finally, we also have commentary from one of Australia's most respected economists, the man that you see here today, Ivan Colhoun. So he'll be providing a lot of that insight to you in a few minutes' time. So just a couple of the new components of the BRI. The credit rating barometer is a series that's based on our risk score data to show the level of risk according to the main credit rating bands from premium to subprime. So very useful in particular for lenders, for tier 2 lenders, for example. The small business failure rate is a systemic risk indicator showing the level of risk among SMEs, and we're currently seeing that rise. That's currently 12% above the 10-year average. And then finally, the economic conditions tracker, which is a forward-looking indicator that incorporates a bunch of consumer and business data to give us an indication of conditions within the Australian economy. Okay, let's get into it. I'll hand over to James now. Hopefully, James, you've sorted out your audio issues. James is just going to take you through a bit of the development of the business risk monitor, and then Ivan will, as well as some insights, and then Ivan will go into a deeper dive of some of the insights.
Right.
Okay.
Thanks, Michael. So yeah, I'll cover things off from a fairly high level, starting with the new credit rating barometer. Best way to think of this, if you think of some of the global rating agencies like Moody's and S&P, every quarter or year kind of run their default analysis. It's sort of like that, but for the small business, excuse me, sector. So starting off with, of course, the CreditorWatch credit ratings. So you can see lots of ratings there, but these ratings really separate businesses by their likelihood of failure. And when we define failure, that is simply either a business insolvency or an asset strike-off. So those are essentially disorderly exits. Now there's 30-odd risk factors and 8 models behind the ratings, which you can see on your screen. Probably a good way to think of those ratings is at the top level with those alpha ratings, so the A to F rating. So at the top of the tree, you've got the investment grade. That's a really small percentage of Australian businesses, so less than 1% of really large corporates sit in that group. The B ratings, so that's sort of ranging similar to an S&P, sort of double B type level of risk. Those business, about 20 to 30% of businesses sit in that category, and they're typically sort of more mature, sort of established businesses. The C ratings are your average business, so they're what we call our mid-tier or prime segment. So on a global rating scale, they're really equivalent to about a single B risk. So about 60% of Aussie businesses sit in that group. And then once you get to the D and E and below, that's what we'd sort of regard as the subprime. So the next slide will show a bit of a view of the business failure rates by rating. So I mentioned the credit ratings really separate those business failure rates. As I mentioned, that's the percentage of businesses that are going insolvent or an asset strike-off. You can see the nice little dip in the middle there. That's really the after effect of COVID. If you click to the next slide, you'll see that on we'll drill into some of these segments. So the mid-tier, this is, as I said, this is where most businesses sit. So we'd say this is probably the best sort of average business type segment. So you can see those failure rates, in some respects, quite stable if you take out the dip with COVID. But you can see the C3, which is the highest risk of these grades, sort of tracked around sort of 10%, and has really effectively bounced back to where it was sort of pre-COVID. Similar story across all of the ratings there. On the next slide, we've got the premium segment. So it's quite interesting. These are the on average lower risk businesses. Probably the highest risk within the premium, the B3, we've seen is one rating that's really sort of drifted up a bit. We do often see in times of stress that your lower rated entities have bigger proportional changes. So, but still in absolute terms, a relatively small shift. And then finally, the subprime on the next slide. Okay, so you can see there, so the average risk of this segment, it's an average rating, in the high teens to 20%. But again, and what you'll see across all the ratings I'll get to in the next section, despite some upheaval in the economy with high inflation, we're still relatively close to a really long-term average. So, bit of a teaser. So in the report itself, in the BRM in coming months, we'll actually drill a lot deeper into the ratings. So we'll look at things like rating transitions. We'll look at ratings in different industry sectors, etc. But the top level view, you can see that table there. We've seen pretty much across all different rating categories, about anywhere between a sort of 12 to 15% increase in business failure rates. Although I'll get to a bit later, that's sort of coming back to a long-term average. Despite that kind of recent rise, Australia actually has had a fairly benign economy for the last sort of at least 10 years. So we really haven't seen any major stress on a broad scale in Australia. This is pretty consistent with what we see. We work with a lot of the banks and non-bank lenders, pretty consistent with what we see at loan books as well. The fourth bullet point there, the question that always comes up is that, does this just mean that Australian businesses are really resilient, or does it actually mean we haven't experienced any genuine stress? And I'll leave that as an open question that I think Ivan can cover in his sections. All right, so moving on to the next section. So looking at the small business failure rate, or really this is a measure of systemic risk, our point in cycle measure. So I'll define what that is shortly. But this is the new index, and what it is in really simple terms, it's what we call a point in cycle ratio. It's simply looking at the current business failure rate in each of those rating categories divided by a long-term average. And the average we've taken for the long term is a rolling sort of 10-year period. So you can see, for example, the mid-tier, which we'd suggest is the best indicator for typical small businesses. Yes, the failure rates have gone up. They're about 12% above a long-term average. We'd suggest that once you start getting to about a 1.5x, that's when you're in danger of getting to downturns and stress. And I'll sort of expand on that a bit later. The next slide. So what do I mean by point in cycle? So point in cycle is a pretty common term, and it's really a measure of how the economy looks today. It's most often sort of talked about in the context of looking at the risk in credit portfolios or loan books. And it's really a simple concept. It's typically defined as, pick your favorite economic indicator and look at the value today divided by a long-term average. Now, there's no kind of right indicator. There's lots of different measures that we typically look at. So things like insolvencies, business failure rates, often on loan books, things like delinquency rates or loan default rates, even things like provision or impairment ratios. So it can be useful to look at different metrics, but they all tend to show the same sorts of things. Okay, so yeah, this is sort of showing some global data. On the left, sort of showing the long-term sort of delinquency rate from data from the Federal Reserve. So this is US data. So this is real estate on the left, and on the right is business loans. So you can see in where countries have kept sort of longer-term data, that ratio, it can often get in real bad downturns. It typically gets to about 5. What we tend to see is that once that ratio gets above about 1.5 on different global data sets, whether you're looking at this US data, some of the European data and rating agency data, often when it gets above 1.5, it keeps going. But generally recognised downturns, typically it's sort of in the range of 2 to 5 scale up. So it's interesting to compare that sort of global data to last sort of 25 years in Australia. So this slide shows a monthly ratio of the number of business insolvencies divided by the number of registered businesses. And you can see, you basically can't see the downturns like you can see in some of that global data. So some of those downturns that are labelled in the last one around the GFC and the dot-com crash, you really didn't see any big scale up. Certainly not, 2, 3, 4, 5x scale up. So it's actually quite remarkable how stable, loan books and then performance of actual businesses has been in Australia. So you put all that together. So this is looking at that mid-tier segment. So the business failure rate compared to the long term. So you can see it's really hugged the long term. So you actually haven't seen those big departures. Same on the next slide when you look at the premium and subprime, same sort of thing. So we look across different rating segments, different types of business. You see the same story that, the last 10 years have been pretty close to the long-term average. And then so you bring all that together, and that's how we get the index. So we're really just introducing it today. So we'll start sort of tracking this index. And like I said, we generally look at this index, and when it sort of hits sort of that 1.5 is where we start to get worried. And then obviously we're interested in the direction. So at the moment we're maybe a little too early to tell, but we've seen it sort of gone up a bit, but it looks like it's the rate of change is decreased and it's flattening. And one of the things when we release a report and we dig more into sub-segments, is you can look at these broad categories of most Australian businesses in that mid-tier rating, but that doesn't mean there aren't what we call risk hotspots. So there's definitely segments where there is stress. So the classic one is hospitality. At the moment, if you look at the ratio of business failure rates or insolvencies, it's more than double the long-term average. So in our view, we regard the hospitality industry as being currently right now in a downturn. Construction less so. So construction is the other one in the yellow line there on the chart. That has hit that 1.5, but it looks very much like, particularly when you look at some of the monthly data, that it's really flattened out. So we'll continue as we move along to sort of do case studies in various sort of segments where there may not be a national downturn, but there can certainly be downturns in certain sectors. And just finishing my section, I mean, the high-level picture is the business failure rates have largely reverted to the mean. So they've really returned to a little bit above a long-term average. We'd sort of regard, at least sort of nationwide, we're pretty well and truly in the safe zone in terms of not drifting towards major downturns. And that's despite some pretty big pressures, particularly around inflation and other factors. Probably I'll just call out the last sort of set of bullet points there. The national statistics can hide some of these hotspots. I mentioned the two industries, sort of hospitality and construction. The other ones that we'll be talking about more, road transport, particularly long haul trucks, we're seeing quite high impairments and loss rates for asset finance lenders. Borrowers with really high interest unsecured credit, they're still seeing quite a bit of stress in the market. An interesting one, renter directors. So most business, it's actually a pretty small subset of business owners are renters, but for those that are, they're a pretty high risk segment, and the cost of rents is actually really starting to affect those people and their businesses. And then, as always, there's location hotspots as well. So for a while now, sort of around that Western Sydney, southeast Queensland, and some of the outer ring suburbs in Melbourne.
Great. Thanks for that, James. Just before we hand over to Ivan, just a reminder that if you have any questions you'd like James or Ivan to address, please type them into the box on the right-hand side of your screen, and we'll get to those as soon as we can. Okay, let's hand over to CreditorWatch Chief Economist Ivan Colhoun, who's going to take you through the economic outlook. Over to you, Ivan.
Thanks, Michael and James. And I guess all of those slides that James has shown, I mean, I guess the big thing you have to look out for is always recession. That's the one where we get really bad defaults. And the US has had 3 big recessions, or 3 significant recessions, and Australia hasn't really seen a true recession since the early 1990s. So that's what we've got to be on the lookout for. Couple of things. So normally when I start my presentation, I start by talking about megatrends. And these are some very, very big themes and trends that are affecting the economy and how businesses work over the next couple of decades. They're not really the shorter term forces that I'll talk about in the next slide. And these themes are have been they're all already working through the economy. And of course, AI is one of the most reported ones at the moment. But I mean, technology in general, I think continues to evolve. Even I was just thinking about a golf example for anyone who plays golf. Now you've got an app to do your scoring. So you think about the business that made the pencils that you got at all golf clubs to mark your score. Again, another example of how the iPhone or the various phones have changed businesses. So big question out there about AI, which businesses will fail as a result of that. From an economic perspective, will more jobs be destroyed than created, which most people tend to think. And then there's all these other big issues going on. So those are running through all businesses, all economies at this point in time. When we think about the shorter term, which is the next 12 to 18 months, then I think these are the big forces that are affecting the outlook. So Mr. Trump is a big force, and his policies, and particularly the tariff policies. Then I think really importantly, we've had those really big increases in costs and prices over the last 4 years. And they're not reversing. I think that I'll show a slide on that. That's been a big pressure for consumers and also for businesses, because business costs have also gone up. As I said, we've got all those mega trends running through the economy as well. Not all of them are negative. Obviously, AI is creating something. There's something of I call it a space race going on to dominate that area. And then we've got lower interest rates. So there's a lot going on, and I'll give you a few tips about how to deal with forecasts when there's a lot going on. So I think the story about inflation, though, this has been one of the big pressures when you think about when prices change really quickly in a short period of time, either up or down. It's very hard to deal with. And we hear a lot about the cost of living when we're talking about consumers, and as a consumer, we experience that. But the other side of that coin is the cost of doing business has gone up a lot. So you think about wages, you think about insurance, most rents, electricity, and or other forms of energy. They're much higher. So they're up, and that has been, I think, an important form, source of stress in the construction sector. Very important, because a lot of builders had those fixed price contracts, and building material prices, they've gone up more than that 26%. They're more like 40-45% over the last 4 years. So even if inflation has moderated to 2.5%, it's still going up from these much higher levels of prices. So that is a challenge for many businesses. So when you've got all these different forces, I tend to say, let's look at some macro indicators that add up all of those forces, and if you like, give you a bottom line for what's happening in the economy. And I think the single best indicator is the unemployment rate. When times are going well, or times are good and the economy is performing well, the unemployment rate goes down. When times are bad, tough, the unemployment rate goes up. Now it's a bit jagged or jumpy, so don't overestimate or overemphasize 1 month, but look at the general trend. So the black line, the unemployment rate has drifted slightly up in Australia. It's not particularly bad. In fact, it's very, very low. If you talk about the economy as a general, and I guess thinking back to James's slide where conditions and failure rates were below these long-term averages, then we got to this very low unemployment rate in 22 and 23, and then we've been drifting up a bit, but by and large, still very low. So that's a great indicator to watch. Then I tend to look at what are good indicators that tell me where the unemployment rate's going to go. Job ads is one, unemployment expectations is another. Now this chart, job ads are plotted inverse. So if you look at the blue line, when it's going up, there's less job ads around. When it's coming down, there are more job ads. And there's always more job ads when business is good, businesses are expanding, they're hiring more people. So I think this is going to be a critical indicator to watch over the next 3 to 5 years to get an idea about how AI is affecting the labour market. Probably even more important to look at equivalent sorts of measures in the US, because I think the US is more advanced on the AI scale. But also in the short term, you can see that that job ad series looks like it's rolling over, which means perhaps there are more job ads, the labour market's beginning to tighten. Now, that would be a huge surprise. It would mean that there weren't many more interest rate cuts to come if we start seeing more job ads. So watch that space very, very closely. And then my third...
Just going back to the state-by-state breakdown of unemployment, I think people might be interested to, if you could expand a little bit on why we're seeing Victoria, it's plateaued now, but why we saw the increase there in the around 23, 24?
Yeah, I think Victoria has, a lot of the states have got debt challenges, and in fact, Victoria's probably got one of the worst debt challenges. And then, of course, their government, trying to deal with that, has put up taxes quite a lot, particularly on property. So that's created quite a negative picture. The other thing that was true was during COVID, Victoria, as we all know, had some of the worst lockdown laws in the whole of the world, rather than just Australia. And that slowed down population growth quite a lot. So I think those general forces have been there. When you look at it, it's not a huge difference in the unemployment rate. If you look back to 18 and 19, there were much bigger variations between the states. This is a few percentage points, but it's generally reflecting the fact that Victoria is, it's a bit more challenged from a tax sense in the short term. Now, I think Victoria still has a lot going for it. Land is cheaper there, so you can buy a house and land package a lot cheaper than New South Wales. So I do expect the population growth to come back in time, but it's just a little challenged at this point in time. Going back to my third favourite indicator, it's the NAB Business Survey Business Conditions Measure. And this is a survey of 400 businesses every month. When this measures above +10, conditions are very good. Businesses tend to be expanding. When it's below 0, conditions are quite weak. And you can see -10 was the two slowdowns Australia saw as a result of the US, but they weren't real recessions. So the early 2000s was the dot-com bust. We weren't really that big in dot-com. And then the global financial crisis did have an impact. But those were weak conditions. But a recession is more like your minus 20s, minus 30s, minus 40s. We had temporarily saw those sorts of levels in the COVID pandemic. So what we've done in the Business Risk Monitor is try to put all of those, or some of those key themes together, and we've got this new economic conditions tracker. The things that go into that are the finances of households, the profitability of businesses, and what's happening to unemployment. And what you can see there, I think there's two elements to this, this tracker. Is one, it's the level of the index. So when it's very low or very high, then you would tend to be seeing high risk, like bad. When it's very low, it's bad economic conditions. When it's very high, it's good economic conditions. So the level's important. And then, and zero is like James's measures, that's a long-term average. This one goes right back to 1997. So it's a very long-term average. And then the direction of travel is also important. So at the moment, we're moving in a direction where after COVID, as prices went up, inflation was high, interest rates went up, we had higher risk conditions. The macro setting became less favourable, not super, bad, but a lot worse than it had been for the last couple of years. And then more recently, it started to improve a bit. It's still slightly on the wrong side of zero, but it's been improving since the government made those income tax cuts in the middle of last year. And then it's improving a bit further at the moment because the Reserve Bank's been cutting interest rates. And overall, it's had only a moderate risk level because the unemployment rate is staying very low. If that was higher, then I think we'd see a different setting. So all of that says, I think James talked about some of the insolvencies and business failure rates likely to level off. This measure at the moment is saying, conditions are improving a little bit. So let's have a look at some of the other things we report in the Business Risk Monitor and see if we can see those trends happening or not. So I always follow the ASIC data each month. I'm surprised that's not reported on a bit more. There's two things I'm showing in this table. I know there's a lot of data in it, but firstly, if we look at the first column of numbers, that is sectoral insolvency. So you can see the hotspots James talked about. Construction has had the most number of insolvencies in the first 2 months of this year, and hospitality is the second highest number. Now, I think one thing that's important is to scale or think about these businesses relative to the number of businesses in the sector. So construction has the most number of businesses of any sector registered in Australia. So 614 insolvencies compared to 462,000 businesses is actually not a huge share. And you can see that accommodation and food services, so hospitality, has a much higher incidence of insolvency, even though it's got about a third or a quarter of the businesses. What's been interesting is mining has picked up quite a bit in recent months. Not a lot of insolvencies by number, but as an incidence of the number of operating businesses, there, then you can see that there are, it's much higher. It's the highest of any of the sectors. And even within mining, there's quite different stories. So up until very recently, lithium prices were very, very low. Coal prices, you would be hearing and probably reading about layoffs in various coal mining regions, which would put some businesses in those regions, I guess, at risk. At the other end of the spectrum, we see actually the farm sector. It's picked up a bit this the start of this year, but it's still overall very, very low rates of insolvency at this point in time. There was one other thing I was going to say, which has slipped my mind there. I will come back to it if I remember it.
Ivan, I think people might be interested to know when you think there might be a sort of a. We've seen insolvencies obviously plateau in recent months. When do you expect there might be a significant turnaround in fortunes for Australian businesses, and we might actually see a strong downward trend in insolvencies?
Yeah, well, that's a good question, Michael, and luckily the next chart probably addresses some of that. So this is the trend that Michael mentioned. So you can see the number of insolvencies. We've got some tram tracks there, or train lines. The last 6 months we've been saying it looks like they've relatively peaked. But remember, the number of insolvencies that should tend to grow with the economy, as the economy gets bigger and bigger, and there are more and more businesses. A certain number of businesses fail every year, so that should trend higher in time. Now, the previous chart I scaled insolvencies by operating businesses. This is insolvencies as a share of registered companies, and the number of registered companies has risen a lot. So you can see there insolvencies are elevated. They're not super elevated, but they are clearly higher than they were pre-COVID at this stage. So the question, I guess, the most interesting question for me is, why was the pre-COVID environment actually relatively low as a share of operating businesses or registered businesses for insolvencies? And I suspect it's because infinterest rates were low and declining through that period, because growth was pretty steady and inflation was low. And what we've seen more recently is a bit of a turnaround in those three themes, but again, not a recession. If we'd seen a recession, we would see very different environment. So I think, Michael, to answer your question directly, it's when the economy gets back to better growth, lower inflation, lower interest rates, and I'll show you what the Reserve Bank's forecasts say about that at the end of this presentation shortly. So
it's fair to say then that those sectors like hospitality that are more heavily exposed to discretionary spending will continue to feel the pinch for some time yet then.
Well, let me show you. I'll show you a chart on that shortly. So what we do is we look at the economic conditions, and we look at the insolvencies data, and we look at our tracker, and then we cross-check it or triangulate it, I'd like to use, with some of the CreditorWatch data and other information that we check. So one of my favourite indicators from CreditorWatch is these business-to-business registered payment defaults. So this is when one customer says, "Hey, XYZ business is not paying their invoices." And you can see in the right hand of that chart, the probability of that company when it has a registered payment default in the CreditorWatch system against it, becoming insolvent over the next 12 months, and this is just with one strike, rises to 8%. And if it's 2 or 3 strikes, it's 12%. And if it's 4 or more, it's up towards 18%, so or 16%. So these are really, really important trends. So what we have been seeing is trade payment defaults decline a bit. That was consistent with that trend we'd seen in insolvencies, but then they bounced back up in July and they've stayed elevated in August. So that's a little bit of a warning signal that there's still some pressures out there, I think. The other indicator we follow very closely is ATO tax debts. This is the number of defaults over 100,000. You can see there's 30,000 cumulative, and you can see the light grey bars are the number of new counts being added. So again, that had moderated from February and jumped up again in July. So there's a few things there, Michael, in terms of your question, that are saying, look, it's not all improving in a sense just yet, but I think the economic conditions tracker, that should be ahead of these trends, and it should be telling us that we should expect to see things moderate a bit. But again, the probability, the chart on the right says, if you have a tax default against you, that's a huge red flag for a probability of insolvency over the next 12 months. Just as if you have a trade payment default on our system, that is a big red flag as well. So those would be two I'd say watch very, very closely. So when I look at construction and hospitality, insolvencies have come down there. I look at a lot of other sectors, they haven't come down. So I'm tending to think there might be something else going on. And when we looked at small business restructures, we actually found that they've dropped down quite a lot in the first 2 months of the year. So we're wondering if that's actually the ATO getting a bit tougher on companies' payment plans and interest charges, and so that decline in insolvencies isn't quite yet saying things have improved. The economic conditions tracker is saying they should begin to improve, but we're probably thinking it's more some changed behaviour by businesses, maybe as a result of the ATO getting a bit tougher on tax defaults. So to finish up and leave some time for questions, what are the forecasts? So the Reserve Bank is forecasting, and actually most economists are forecasting a soft landing for the economy, or nearly, or were. They were expecting inflation to moderate to around 2.5%. They're expecting growth with that moderation in inflation, that cash rates could come down. The cash rates coming down would allow growth to strengthen a bit, and that stronger growth would keep the unemployment rate quite low. So that is a near perfect soft landing for the economy. What are the risks? I think they're mainly external. They're unfortunately mainly Mr. Trump's trade policies. But there are some tailwinds as well. This AI arms race or space race is creating a lot of activity. We've also got strength in, the aging population is driving various investments, as is the climate change as well, and defence in geopolitics. So for the moment, it looks like the economy is performing okay. The rate cuts should help out going forward as well. So I'm going to finish there, and we can take some questions in the chat screen. Michael might already see all of those. And just the final point is, if you would like to subscribe to the Business Risk Monitor to get a monthly update on some of these trends, please scan that QR code.
So yeah, thanks, Ivan. That was fantastic. Really, really good insights there. So we will be sending out the recording of this webinar tomorrow, as well as a copy of the Business Risk Monitor report. But yeah, please send through some questions now if you'd like Ivan or James to address those. Ivan, just someone has asked a question about tariffs, obviously a big one, and a lot of uncertainty, as you said, but how big an impact do you see these tariffs actually having on the Australian economy?
Yeah, look, that's a great question, and I think I've looked at, there's a great website called the Budget Lab at Yale University, and they calculate, and it's on the, you can Google it whenever there's a tariff change. They calculate the impact of the tariffs on the US economy, all right? And they're most directly impacting the US economy. So the type of numbers they're coming up with at the moment is it's going to slow US growth by about 0.5% this year and 0.5% next year, and raise the unemployment rate in the US by about 0.4%. So those aren't devastating or huge impacts from the tariffs that are there. And then, of course, so you think about that's what it's going to impact the US. Now, the US have got higher tariffs on China, which we're more exposed to, but we also, Australia, got the lowest tariff setting of any other country. So in some sectors, we're actually benefiting. If you're a beef exporter, because the US is tariffing, that's a verb, Brazil higher than Australia, it's led to this quite a big increase in the demand and price of Australian beef. So there's a bit of swings and roundabouts. More generally, we're expecting it to be a bit slower. A tariff is like a tax. It's like a sales tax. So if you put up a tax, it always slows growth somewhat. But it's mainly impacting on the US economy.
Great, thanks for that. And someone else has asked about interest rates, what your outlook is for interest rates for the remainder of 2025 and into 2026.
Okay, so the Reserve Bank, their latest forecasts assume there will be 2 more interest rate cuts in Australia. Their latest minute said, we've got to decide on our strategy, whether we should front load those interest rate cuts to keep unemployment low, or if things stay reasonable, we could space them out over the remainder of the year. I would think there's virtually no chance they cut interest rates next week, because the unemployment rate that was released earlier this month was 4.2% still. They're going to be most sensitive to the unemployment rate. We might get 1 cut before Christmas. That would be my best option. And I'm going to be watching that chart of job ads very closely, because if there are more job ads, they normally don't cut interest rates. So I think the best outcome is 1 or 2 more cuts, but I'm getting a bit more cautious about whether I don't think we'll get more than 2. And the other point I'd make is I don't think we should want to get more than 2. Right? Interest rate cuts, you get a lot of interest rate cuts when times are bad, when the economy is slowing down or in recession. So it would be good if we got that sort of soft landing where growth, inflation was low, growth was okay, unemployment stayed low. That would be a good outcome.
Right. All right. Well, we might wind it up there. But thank you to you, Ivan, and to you, James, for your valuable insights today. Just a quick poll question to finish up. Would you like more information on CreditorWatch's credit reporting capabilities? So thanks everybody for joining us today. Our next webinar will be the 21st of October with ATO Assistant Commissioner for Enforcement, Anita Challen. She'll be outlining the ATO's current approach to debt enforcement. So don't miss that one. There should be some really valuable insights on that one as well. Thanks again, Ivan. Thanks, James.
Thank you.
And we'll see you next time.